Okay, so Xerox just dropped their fourth quarter earnings, and wow, the market's reaction was, well, it was brutal. We're going to break down exactly what went wrong, what management is saying they'll do about it, and what it all means for the stock going forward. Let's dive right in. So, the big one everyone was watching, earnings per share. Wall Street was looking for a profit of about 29 cents. Instead, Xerox reported a loss of 10 cents. I mean, that is a massive 39-cent miss. Right out of the gate, that set off some serious alarm bells. And, it wasn't just the bottom line that had issues. The top line, their revenue, also came in a little light. They posted just over $2 billion, which sounds like a lot, but it fell short of what analysts were expecting by about $22 million. So you've got a miss on both earnings and revenue. That's not the kind of story you want to be telling investors. And this right here, this is exactly how the market felt about it. The stock just got hammered, dropping over 12% in a single day. And look at the volume. It was about 2.5 times the normal daily average. This tells you it wasn't just a few people getting nervous. This was a big institutional move to the exits. The market sent a very, very clear message. So, okay, why the big miss? Why the huge reaction? The headline numbers only tell you part of the story. To really get what's going on, we need to pop the hood and look at the engine of the core business. Now, this is where it gets really interesting. Look at that pro forma revenue. See, their reported revenue was actually up over 25%, but that's kind of misleading because it includes a bunch of recent acquisitions. When you strip those out to get a real apples-to-apples comparison, their core business revenue was actually down 9%. Not only that, but their profit margins got squeezed, and their free cash flow, the actual cash the business generates, was down big time. That 9% drop is a huge red flag that the core business is really struggling right now. And let's be really clear here. This is not just one bad quarter. This chart puts everything into perspective. Over the past year, Xerox stock has absolutely plummeted, down almost 75%, while the S&P 500 is up almost 18%. I mean, that is not a dip. That is a massive long-term underperformance. And it's exactly why investors were so quick to punish another piece of bad news. So that's all the bad news. But what did management have to say about all this? Well, if you listen to the earnings call, they painted a much rosier picture of the future. Let's take a look at their side of the story. So the CEO, he did acknowledge some macro headwinds, things like economic uncertainty, rising costs, the usual suspects. But his main message was actually overwhelmingly positive. He really stressed that integrating their recent acquisitions is ahead of plan and that they're already seeing tangible synergies. That's corporate speak for real cost savings and new business. So management's core argument is, hey, the plan is working and the market is just overreacting to some short-term noise. And they didn't just talk, they backed it up with some pretty bullish guidance for next year. They're projecting revenue to jump to over $7.5 billion, a big leap in operating income, and around $250 million in free cash flow. This guidance is basically telling the street that a huge turnaround in profits and cash generation is right around the corner. So where's all this confidence coming from? Well, it's built on these 3 pillars. They believe that if they execute their reinvention plan, get all the benefits from those acquisitions, and use the cash to pay down debt, they can hit those really optimistic targets. This is the roadmap they're selling. And that, right there, brings us to the central conflict of this whole story. You've got this massive disconnect between the turnaround picture management is painting and the absolute beatdown the market delivered. There is a serious credibility gap here. I mean, this slide just lays it all out perfectly. On one side, you have management's bright and shiny guidance. On the other side, you have the market's brutal, immediate reaction. When a company guides for a major profit improvement and the stock tanks on heavy volume like that, it tells you one thing, loud and clear. The market does not believe the story. At least, not yet. So what's it going to take to close this credibility gap? Well, the answer is pretty simple. Proof. The market has basically moved from trust us to show us the money. Investors need to see tangible evidence that those acquisition synergies are actually helping the bottom line and that the company is truly on track to generate that $250 million in free cash. Words just aren't going to cut it anymore. Which, of course, all leads to the big picture question for anybody looking at the stock right now. Is this a setup for a huge turnaround, or is it a classic value trap? Let's break down our view on what happens next. Yeah, this is the multi-billion-dollar question, isn't it? After a 75% drop, is this stock a screaming bargain just waiting to rebound, or is it cheap for a very good reason?
Management has laid out their plan. The market has cast its vote of no confidence. So where do we go from here?
All right, for the next call, we're rating Xerox as an underperform. We think the stock is going to stay volatile and under pressure until the company delivers that concrete proof we talked about. The single most important thing to watch for next quarter is that free cash flow number. Can they show they're on a path to hit their annual goal? Until they do, we expect the stock price is really going to struggle to break above its key moving averages. The burden of proof is now squarely on management's shoulders. And just a quick reminder for everyone, this is not financial advice.